Welcome to Griffonomics.
It's a really fascinating time to be looking at the aerospace sector right now, especially with the massive shifts we're seeing in capital allocation.
Yeah, absolutely. And if you, the listener, want to really understand the sheer scale of the engineering and financial puzzle we are unpacking today, I want you to just imagine a scenario for a second.
Okay, I like where this is going.
So you are tasked with intercepting a threat, and this threat is traveling at Mach 15.
Right, which is, that's roughly 11,000 miles per hour.
Exactly, just a blinding speed. And you are operating in the cold, dark vacuum of space.
Right.
So there is no air friction. There is no weather. You can't use traditional steering like you would on an airplane.
Because there's no air to push against.
Right. And you have to hit this target head on, completely destroying it through kinetic force alone. So hitting a bullet with a bullet.
Which is incredibly difficult.
Oh, it's near impossible. Now imagine trying to build a profitable, publicly traded business out of solving that exact physics problem while simultaneously trying to build the next floating city in low Earth orbit.
Yeah, that is the Voyager story in a nutshell.
Exactly. So today our mission is generating a highly granular strategic report and an investment roadmap for Voyager Technologies. And their ticker symbol is VOYG.
And the dual horizon nature of this company makes it an incredibly complex subject to analyze. You have deep defense technology on one side and then massive commercial space infrastructure on the other.
Right. And to try and make sense of it all, we've brought the receipts. If you're navigating this deep dive with us today, we are pulling from a really massive stack of recent SEC filings, so the 10K, the 10Q.
Yeah, plus their Q1 2026 earnings call transcripts.
Exactly. And we've got analyst reports from Citi and Wedbush and, a whole flurry of recent press releases.
Which is a lot of reading.
It is a ton of reading.
Yeah.
But our goal is to answer a very specific framing question here. How does a company that started out doing basically experimental science ventures on the International Space Station rapidly transform into what some Wall Street analysts are now openly calling the next Lockheed of advanced propulsion?
Right. And to map that kind of transformation, we really have to look at the structural foundation first.
Because you can't just pivot like that overnight.
No, absolutely not. A metamorphosis like that requires a complete operational teardown, which is exactly what Voyager executed heading into 2026.
Yeah, I saw that in the filings.
Right. The 10K shows this very deliberate shift away from a fragmented startup mentality into a highly concentrated dual segment corporate structure.
They basically consolidated everything into just 2 reporting segments, which makes it a lot easier to track.
Yeah.
So let's start with the one that's actually bringing in the cash right now.
Yeah, that would be the Defense and Space Technologies segment. And as of the first quarter of 2026, this segment is just the absolute lifeblood of the company. It is generating 100% of their recognized sales.
Wow, literally all of it.
All of it. And the strategy here wasn't just, organic growth. It was highly aggressive, highly targeted M&A.
Mergers and acquisitions.
Right. They essentially bolted together this vertically integrated powerhouse through a string of 12 strategic acquisitions since 2019.
12 acquisitions in just a few years. That is aggressive.
It really is. And 2 of the most critical puzzle pieces they bought were Exoterra and Estes.
Okay, let's break those down. What did Exoterra bring to the table?
So Exoterra brought cutting-edge electric propulsion in-house, and that is vital for long-duration satellite movement.
Right, moving stuff around efficiently once it's already up there.
Exactly. But Estes brought something much more explosive, literally. They brought energetics.
Okay, wait, I have to stop you right there. I see the word energetics plastered all over these defense reports. What does that actually mean, practically, in the context of building a missile or a rocket?
Yeah, it sounds like a buzzword, but it is the raw, fundamental chemistry of propulsion and destruction.
Chemistry, not hardware.
Exactly. When defense contractors talk about energetics, they are referring to the solid chemical propellants, the explosive warheads, and, the highly volatile compounds that physically generate thrust or kinetic yield.
Okay, so building the metal casing of a rocket is one thing.
Right. But formulating the highly controlled chemical explosion that safely and reliably pushes that metal casing into the exosphere, that is an entirely different scientific discipline.
It's basically applied bomb making.
Essentially, yes. So by acquiring Estes, Voyager wasn't just buying a cool brand, they were buying the actual chemical formulas and the deep manufacturing heritage to produce the fuel that the Department of Defense completely relies on.
That is a massive competitive advantage. So segment 1 is this vertically integrated defense contractor that makes both the complex hardware and the explosive chemistry that goes inside it.
Correct.
So what is the second segment then?
So segment 2 is Starlab space stations. And if the Defense and Space Technologies segment is the engine paying the bills today, while Starlab is the multi-billion-dollar infrastructure play of tomorrow.
The floating city we mentioned earlier.
Right. Starlab is a global joint venture, and it's led by Voyager with a very singular, daunting mandate.
It is.
They have to design, build, launch, and operate the commercial successor to the International Space Station before the ISS is decommissioned in 2030.
That is a wildly ambitious timeline. 2030 is right around the corner in aerospace terms.
It is basically tomorrow.
Yeah. We will definitely get into the weeds on how you build a space station without bankrupting the company in a minute. But before we go there, something in the operational model of their defense segment really stood out to me in the sources.
Oh, the prime versus merchant dynamic.
Exactly. The filings talk about Voyager acting as both a prime contractor and a merchant supplier. Can you explain the difference there and why playing both sides of that fence is such a big deal?
Yeah, it's crucial because the distinction between a prime and a merchant supplier, it essentially dictates how power and money flow in the entire defense industry.
Okay.
So traditionally, a prime contractor, think of massive legacy entities like Lockheed Martin, Raytheon, or Boeing. They deal directly with the U.S. government.
They are the ones signing the mega contracts.
Right.
Yeah.
They bid on multi-billion-dollar, decade-long programs, and they take on the massive, overarching risk of delivering a finished, fully integrated product like a fighter jet or a nuclear submarine.
The whole package. So then what does a merchant supplier do?
Merchant suppliers are the Tier 1 and Tier 2 subcontractors. They don't sell to the government directly. Instead, they sell specialized components like radar sensors or landing gear or propulsion units to the primes.
I see. It sounds a bit like the smartphone industry, honestly.
How so?
Well, you have a company that builds and sells the flagship phone directly to you, the consumer. And they take all the marketing risk, all the inventory risk.
Right.
But then you have a separate company that just manufactures the advanced camera sensor that goes inside. And they are perfectly happy to sell that same sensor to 3 different competing phone brands. They win no matter whose phone you buy.
That captures the dynamic perfectly. The merchant supplier avoids the massive systemic risk of a failed government bid.
Because if Lockheed Martin loses a fighter jet contract to Boeing, Lockheed stock takes a huge hit.
Exactly. But if the merchant supplier is selling the landing gear to both Lockheed and Boeing, they get paid regardless of who actually wins the final government contract.
That is a great position to be in. So Voyager does both.
Yes. They have designed an incredibly adaptable dual-role operational model. On certain smaller, highly specialized programs, they act as the prime contractor, dealing directly with NASA or the DoD.
But on the really massive existential defense programs, they step back into that merchant role.
Right. They position themselves as the indispensable bottleneck. They supply the ultra-advanced propulsion modules and optical sensors to the legacy primes.
I see.
And this allows Voyager to optimize their margins and really protect their downside. If a prime contract is incredibly capital-intensive and carries massive regulatory risk, Voyager just lets Raytheon or Lockheed take that risk.
And Voyager simply sells them the high-margin components required to actually make the missile work.
Exactly.
That structural flexibility makes a ton of sense, especially when you look at the macro environment they are operating in right now. Because the sources indicate this structure was built explicitly to capitalize on 2 massive catalysts hitting in 2026.
Yes, the dual horizon catalyst.
Right. And the first one is absolutely dominating the analyst reports. They call it the Golden Dome catalyst.
Yeah.
What exactly is this Golden Dome?
So the Golden Dome Initiative represents a monumental shift in how the United States approaches national security. The Department of Defense is pushing forward with a proposed $25 billion multi-layered missile defense architecture.
$25 billion. With a B.
With a B. And the goal is to create an interconnected shield capable of intercepting threats at every conceivable altitude. So, from low-flying drones to submarine-launched ballistics, all the way up to space-based interceptors targeting hypersonic glide vehicles in the exosphere.
Okay, and just to pause here for a second for the listener. Whenever we look at these massive defense budgets or global military posturing on this deep dive, our objective is purely analytical.
Right. We are just looking at the numbers.
Exactly. We follow the capital flow, the supply chain logistics, and the technological advancements.
Yeah.
We're reading the balance sheets and the geopolitical demand signals to understand the business mechanics. We are absolutely not taking any political stance on the defense spending itself. We're just reporting what's in the sources impartially.
Absolutely. And the financial reality of the situation is that $25 billion is entering the procurement pipeline, and Voyager has aggressively positioned itself to capture a very significant piece of that pie.
Exactly. Because they aren't a traditional defense giant.
Well, they are uniquely situated across almost every layer of this proposed architecture because of two distinct, highly proprietary technological moats that they've either developed or acquired.
Okay, let's hear them.
The first moat is known as TDACS. That stands for Throttleable Solid-State Propulsion.
TDACS.
Okay. And the second is their Advanced Optical Navigation and Control Systems.
All right, let's break these down because this gets right back to the heart of that Mach 15 problem we talked about at the very beginning of the deep dive.
The vacuum of space problem.
Exactly. Space is a vacuum, and I think the average person, myself included, assumes that once you are in space, everything just sort of floats in a straight line. Why is steering a missile out there so incredibly difficult that the government needs to spend billions on this proprietary Voyager propulsion?
Well, the primary challenge isn't actually the vacuum of space itself. The challenge is the kinetic energy of the target you are trying to hit.
Because it's moving so fast.
Exactly. When you are attempting to shoot down an incoming hypersonic or ballistic threat, the industry phrase is, as you said, hitting a bullet with a bullet.
Right.
But consider the relative closing speeds here. If your interceptor is traveling at Mach 10 and the incoming threat is traveling at Mach 15, the closure rate is just phenomenal.
You are rushing at each other at thousands of miles an hour.
You have mere fractions of a second to make any final adjustments. So at those speeds, a microscopic miscalculation in your trajectory means you miss the target entirely.
And in missile defense, a near miss is a complete failure. You can't just graze it.
Right, so you have to steer.
But why can't you just, put some fins on the interceptor and steer it like a remote control airplane or a regular missile?
Because fins require air pressure to create drag and physically alter the course of the vehicle.
Yeah.
In the exosphere, there is no atmosphere. There is no air, so fins are completely useless.
Oh, of course. So how do you turn?
The only way to change your vector in a vacuum is through thrust. You have to fire a rocket motor perpendicular to your path to physically push the interceptor sideways.
Okay, so they just stick some small rocket boosters on the side of the missile. That sounds simple enough.
Historically, yes, that is what they did. But traditional solid rocket motors have a fatal flaw for this highly specific application.
What's the flaw?
They are completely binary. A solid rocket motor is essentially a metal tube packed with highly combustible chemistry. Once you ignite it, the chemical reaction cascades. It burns at maximum intensity until the fuel is entirely consumed.
So it's like lighting a firework. You can't unlight it.
Exactly. You cannot easily turn it off, and you certainly cannot dial the thrust up or down like a gas pedal on a car.
So if you can't control the thrust, how on earth do you make a delicate microscopic steering adjustment at Mach 15?
You can't. With traditional motors, you'd end up overcorrecting and missing the target in the completely opposite direction.
Ah, okay. So that is the exact friction point that Voyager's TDDACS technology solves.
Precisely. Through incredibly advanced materials and really complex internal valving, Voyager has developed a solid-state propulsion system that can actually be throttled.
So they can use the gas pedal.
Yes. The interceptor can fire the lateral thrusters, modulate the exact amount of force being output, and even stop and completely restart the burn during mid-flight.
That seems like it defies the basic chemistry of a solid rocket.
It is a massive, massive engineering leap. It allows the interceptor to make highly precise micro-adjustments to its course in the final milliseconds before impact.
Which drastically increases the probability of a direct kinetic kill.
Exactly. Furthermore, the ability to modulate the thrust allows for a much wider glide path. The interceptor can cover significantly more operational volume, loitering or adjusting its approach, while actively saving fuel for the terminal phase of the engagement.
Okay, so they have the steering completely solved with TDACS. But what about the navigation? Because if I want to find my way anywhere on Earth, I just pull out my phone and connect to GPS. Why wouldn't a multi-billion-dollar defense interceptor just use, military-grade GPS to find the target?
Because the physical architecture of the global positioning system makes it basically impossible to use in this specific scenario.
Wait, really? Why?
Consider where the GPS satellites are actually located. They sit in medium Earth orbit, and their antennas are pointed downward, broadcasting their signals toward the surface of the Earth for us to use.
Right.
If you are a space-based interceptor or a missile that has climbed way up into the upper exosphere to hunt a ballistic threat, you are actually above the primary GPS signal cone.
Oh, wow. I never thought about that.
Yeah, you are looking up into the void of space, while the GPS satellites below you are basically shouting down at the ground. You can't hear them.
That is a fascinating blind spot. So if the missile is completely blind to GPS, how does it know where it is, let alone where a hypersonic target is moving?
It has to rely on the oldest form of navigation in human history, the stars.
You are kidding.
I'm serious. But it does so with terrifying modern precision. Voyager's optical navigation systems utilize what are called advanced star trackers.
What exactly is a star tracker?
They are highly specialized, ultra-sensitive space cameras that constantly take pictures of the star field around the interceptor. And an onboard computer instantly compares the positions of those stars to an internal map.
Like a digital constellation map.
Right, and it calculates the interceptor's exact orientation and location in three-dimensional space based on the fixed geometry of the cosmos.
So they are automating ancient celestial navigation using high-speed algorithms and putting it on a missile traveling at Mach 15.
Exactly. It's brilliant. When you combine the optical sensors that can perfectly orient the interceptor in the dark with the throttleable propulsion that can perfectly maneuver it into the target's path, you have an indispensable package.
The DoD essentially has no choice but to integrate Voyager's technology into the Golden Dome architecture. They need it.
Right. And the financial reports confirm this isn't just a theoretical pitch. The filings show they are already monetizing these moats right now.
Yeah, in Q1 2026 alone, Voyager secured a really strategic partnership with Anduril Industries, right?
Yes, to provide these exact technologies for next-generation space-based interceptors.
And they also noted an ongoing $78 million contract with Lockheed Martin, supplying the Stage 2 roll control system and the optical guidance for the next-generation interceptor program.
And that Lockheed contract is the absolute perfect manifestation of the merchant supplier model we discussed earlier.
Because Lockheed takes the prime risk on the multi-billion-dollar program.
Right, they take all the heat. And Voyager quietly cashes a $78 million check to provide the critical steering components.
It's a great setup. But the Golden Dome defense play is really only half the story here.
It is.
Because the defense cash flow is explicitly meant to fund their second massive catalyst, the Starlab joint venture. Let's look at the commercial space side for a minute.
This is where the long-term vision really opens up.
Because the International Space Station is aging out. It has been up there for decades, and the structural fatigue is very real. It's literally slated to be decommissioned and deliberately crashed into the ocean in 2030.
Which is a huge structural shift for orbital research.
And NASA has made it very clear they do not want to be the ones to build the replacement.
No, NASA is fundamentally shifting its operational paradigm. They are transitioning away from the owner-operator model that really defined the Apollo and the Space Shuttle eras.
So what do they want to do instead?
They want to stimulate a purely commercial space economy where they are simply a tenant.
Just renting an apartment in space.
Exactly. They want to buy a ticket, fly up to a commercial space station, conduct their research, and fly home. They don't want to own the building.
So Starlab is designed to be that premier commercial destination in low Earth orbit to capture that NASA budget.
Yes, alongside international space agencies and commercial research clients.
But building a space station seems infinitely more complex and expensive than building a missile component. I mean, the estimates I'm seeing put the Starlab project anywhere from $2.8 billion to $3.3 billion.
It's a massive capital expenditure.
For a company of Voyager's current market cap, how do they shoulder a $3 billion build without crushing their balance sheet into absolute dust?
Well, they avoid carrying that burden alone by systematically de-risking the project through equity partnerships. Voyager realized very early on they couldn't fund or build this in isolation.
So what do?
They gave up portions of equity in the Starlab joint venture to secure a consortium of global elite aerospace and technology partners. They still remain the controlling shareholder, owning roughly 62% of the JV, but the heavy lifting is completely distributed.
Okay, so who did they bring into the fold to actually build this thing? Because it can't just be anybody.
No, it is a formidable roster. They brought in Airbus to handle the technical design and manufacturing of the primary habitat.
And Airbus obviously brings immense heritage to this.
Yeah. Huge heritage. I mean, they built the Columbus module, which is the European science laboratory that is currently attached to the ISS.
Okay, so they know how to build space habitats. Who else?
They partnered with Mitsubishi Corporation to leverage their deep industrial base and their expertise in space research and development.
That covers Japan.
Then they brought in MDA Space. That's the renowned Canadian company that built the iconic robotic arms for the Space Shuttle and the ISS. They will handle all the external robotics and autonomous mission operations.
Incredible.
And crucially, they integrated Palantir to manage the data modeling, the digital twin simulations, and the entire artificial intelligence infrastructure of the station.
Wow. So essentially assembled the Avengers of global aerospace. You have Europe, Japan, Canada, and Silicon Valley all pooling their expertise into one project.
That's a great way to put it.
But looking at the investor presentations and the sources, Starlab doesn't look anything like the ISS. I mean, the ISS looks like this sprawling, chaotic erector set of tubes and solar panels bolted together.
Yeah.
Starlab just looks like one giant, sleek cylinder.
Yeah, the architectural philosophy is a radical departure from the ISS, and that is driven entirely by the realities of modern launch vehicles.
What do you mean?
Well, the ISS took decades to build. It required dozens of space shuttle launches, with astronauts conducting highly dangerous spacewalks just to bolt individual modules together in orbit. It was literally an orbital construction site.
Which sounds incredibly expensive and risky.
It was. Starlab completely abandons that modular approach.
So how do you launch a space station if you don't build it piece by piece in space?
You build it entirely on Earth, inside a single massive 8-meter diameter module, and you launch it all at once.
All at once.
Yes. The entire Starlab habitat is designed specifically to fit inside the payload fairing of SpaceX's Starship.
Oh, wow.
The plan is to load the fully integrated, fully tested space station into the nose cone of Starship, achieve orbit, open the payload doors, and just deploy a fully functional floating laboratory in a single launch scheduled for 2029.
That completely eliminates the risk of in-space assembly.
Yeah.
You don't have to worry about two pieces not fitting together perfectly at 17,000 miles an hour.
Exactly. It changes the fundamental economics and the entire risk profile of space infrastructure. If the Starship launch architecture is successful, it reduces the deployment cost of a space station by orders of magnitude compared to the ISS.
That is a brilliant pivot. So we have these two incredibly ambitious catalysts. They are supplying the propulsion for a $25 billion missile defense shield, and they're building a $3 billion commercial space station.
Right.
But ambitions don't pay the rent.
Mm-hmm.
Let's look at the financial realities right now today, because the Q1 2026 earnings report was a very dense read. What is the actual top-line momentum looking like for Voyager?
The top-line momentum is staggering, honestly, particularly when you look at the future revenue pipeline. Voyager reported a record total backlog of $275.3 million in the first quarter.
$275 million.
Yes. That represents a 54% surge year over year. And this growth was fueled by $45.2 million in fresh Q1 bookings, which resulted in a book-to-bill ratio of 1.3.
Okay, a book-to-bill ratio of 1.3. For someone listening who maybe doesn't stare at financial ratios all day, what does that number actually signify about the health of the company?
It is arguably the most important metric for a manufacturing company in a rapid growth phase. The book-to-bill ratio basically measures the relationship between orders coming in. So, the bookings and revenue being recognized for orders completed the billings.
Right.
A ratio of exactly 1.0 means that for every dollar of product shipped out the door, a new dollar of orders comes in. The pipeline remains stable.
It's flat.
Right. But a ratio of 1.3 means that for every dollar Voyager billed and recognized as revenue in Q1, they actually booked $1.30 in new orders.
So the bathtub is filling up significantly faster than it is draining out.
Precisely. It provides immense visibility into their future cash flows. The demand is heavily outstripping their current production pace, and Chief Financial Officer Phil DeSouza really emphasized this on the earnings call.
What did he say?
He noted that Voyager is actively tracking an overall pipeline of potential opportunities that exceeds $5 billion, stretching out through the 2040s.
$5 billion. But reading further down that Q1 income statement, we hit a massive contradiction that I want to ask you about.
The revenue miss.
Yes, they have this record backlog, the pipeline is basically overflowing, and yet Voyager actually missed Wall Street's Q1 revenue estimates.
They did.
They pulled in $35.2 million, which was a miss of roughly $2.1 million against the analyst expectations. And they also missed on earnings per share by a penny.
Right.
And yet, management confidently raised their full-year revenue guidance to a range of $230 million to $255 million. which implies an acceleration of like 38 to 53% over the previous year.
It's a bold move.
How does a CFO stand up, announce a revenue miss for the quarter, and then tell investors they're actually going to make way more money this year than initially projected?
It seems highly counterintuitive on the surface, but the logic Phil D'Souza laid out reveals a lot about the friction of physical supply chains.
What do you mean by friction?
Well, first, he clarified that while the $35.2 million was a miss against external Wall Street models, it was actually completely in line with management's internal projections.
Oh, so they saw it coming.
Yes. The quarter faced several planned structural headwinds. Specifically, they saw a $5 million year-over-year reduction in revenue because a legacy program called Space Dock 2 naturally concluded,
Okay.
alongside the wind down of an older Airbus software design radio contract.
So they knew a revenue gap was coming because these old contracts were naturally expiring before the massive new Golden Dome contracts fully spun up.
Correct. But the much more complex dynamic driving the raised guidance is what D'Souza referred to as milestone timing.
Milestone timing, what is that?
This is where the reality of aerospace manufacturing diverges wildly from something like a SaaS software company.
Right, because if a software company signs a $10 million contract, they can often begin recognizing that subscription revenue almost immediately.
Exactly. The marginal cost of provisioning a new software user is essentially zero. Voyager, however, is dealing in deep physical hardware.
So when they sign a $78 million contract with Lockheed, they don't just get handed a briefcase of cash that day.
No, absolutely not. They have to actually build the physical hardware. They have to source rare earth metals. They have to manufacture highly volatile chemical propellants. They have to machine titanium components to microscopic tolerances.
Which takes a lot of time.
Exactly. Recognizing that $275 million backlog as actual quarterly revenue is severely choked by the procurement of long lead materials and the rigorous testing schedules demanded by the DoD.
Right.
Revenue is recognized on a percentage of completion basis, or only when specific delivery milestones are successfully met.
I see. So the raised guidance is basically management betting their own jobs that the manufacturing bottlenecks will clear up in the coming months, allowing them to finally ship the product and actually recognize the cash.
That is exactly the bet they are making. They are aggressively transitioning these new defense awards from the design and prototyping phase into high-rate production. Because of this physical friction, Voyager expects a massive back half weighting to their year. They project that 67% of their full year 2026 revenue will hit in the second half of the year, with only 33% realized in the first half.
That is a very steep ramp up.
It is. They anticipate sequential revenue acceleration of roughly 37% heading into Q2, leading to an absolute explosion of physical deliveries in Q3 and Q4.
And the CEO, Dylan Taylor, mentioned that this massive $275 million backlog doesn't even include some of their biggest recent wins.
Right, the unbooked backlog.
Yeah, the Anduril space-based interceptor partnership and the new NASA private astronaut mission contract hadn't even been formally booked yet at the end of Q1. So the unbooked upside is just sitting right there waiting to hit the balance sheet.
The demand is mathematically proven at this point. The entirety of the pressure now rests solely on execution. Can Voyager physically manufacture and deliver the hardware on this compressed timeline?
And to meet those compressed schedules and to make sure their TDACS and optical sensors stay ahead of whatever Lockheed or Raytheon might try to eventually develop in-house, Voyager is pouring an unbelievable amount of capital back into research and development.
The innovation metrics in the filings are just startling.
Yeah.
For the 3 months ended March 31st, 2026, Voyager's innovation spend, which encompasses R&D and proprietary engineering, was an industry-leading 48% of its net sales if you exclude the Starlab entity.
48% is huge.
But if you look at it on a fully consolidated basis, including Starlab, their innovation spend is a staggering 151% of sales.
Wait, 151%.
Yes, they are out-innovating the legacy primes by an order of magnitude.
But spending 151% of your sales on innovation means you are burning capital much, much faster than you are generating it. What are they spending all of this money on?
A significant portion of it is dedicated to dual-use technologies. The philosophy is simple. Compound the value of every single R&D dollar. If Voyager spends $10 million developing a more efficient electric thruster for a military satellite, they want to be able to use that exact same thruster architecture to maneuver a commercial communications satellite.
Oh, so build it once, sell it twice in different markets?
Exactly. But the most capital-intensive and potentially revolutionary area of their innovation spend is their artificial intelligence strategy, which is heavily driven by their partnership with Palantir.
This part of the filings felt like actual science fiction to me. They are trying to put radiation-hardened GPUs directly into orbit. Why on earth do we need artificial intelligence supercomputers floating in space?
To understand the necessity of that, we have to look at the latency problem in modern orbital data collection.
Okay, break that down for us.
Historically, satellites are basically just dumb collection nodes. If a military satellite gathers high-resolution synthetic aperture radar imagery, or if it intercepts an encrypted communications signal, the satellite itself doesn't actually know what it is looking at.
It's just a camera taking a picture.
Exactly. It has to transmit all that massive raw data back down to a ground station on Earth. Then ground-based supercomputers process the data, human analysts review it, identify a threat, and then beam instructions back up to the satellite or a weapons platform.
And beaming terabytes of raw data down from orbit takes time.
It creates a critical latency loop. And in a defensive scenario where you are dealing with hypersonic glide vehicles that can change course unpredictably at Mach 15, a delay of even a few seconds in the data processing loop is completely fatal.
Because the target has already moved miles away by the time the ground station finally sends the intercept command.
Exactly.
So the obvious solution is to put the supercomputer inside the satellite so the satellite can process the data itself.
But why is this so hard? I mean, why can't Voyager just buy a crate of top-tier gaming GPUs from NVIDIA, bolt them into a satellite, and launch it? Because the space environment is incredibly hostile to standard silicon architecture. Outside the protection of Earth's atmosphere, hardware is constantly bombarded by cosmic rays, solar flares, and intense background radiation.
So what happens if radiation hits a computer chip?
If a high-energy radiation particle strikes a standard microchip, it can cause what is called a single event upset.
A single event upset.
Yes, it physically flips a binary bit inside the processor. So a 0 instantly becomes a 1, the logic process corrupts, the entire system crashes, and suddenly your satellite becomes a multi-million-dollar piece of orbital debris.
Wow. Just from one particle.
Yeah.
So how do you harden a computer against cosmic rays?
Radiation hardening is a very complex physical engineering process. It involves manufacturing the chips on specialized insulating substrates using redundant circuits so that if one pathway is struck by radiation, a backup pathway instantly takes over.
Oh, that makes sense.
And it also involves utilizing physical shielding. Voyager, leveraging its acquisition of EMSI, which is a premier developer of automated target recognition software, is working with Palantir to develop these hardened edge computing units.
Which completely inverts the data model we talked about. The satellite no longer beams down raw data.
Correct. The satellite utilizes onboard machine learning algorithms to process the radar imagery in real time right there in space.
Oh, wow.
It recognizes the signature of a hypersonic launch entirely on its own. And instead of beaming down terabytes of raw imagery, it only transmits a tiny instantaneous text alert. Hypersonic threat detected at these exact coordinates on this vector.
That is incredible. It is real-time threat analysis at the absolute edge of the network.
And Voyager was actually recently awarded a $21 million contract from the Air Force Research Laboratory specifically to develop these next-generation AI-enabled intelligence, surveillance, and reconnaissance systems. So they're monetizing the AI before the hardware is even fully finalized.
That's smart.
They are also deploying what they call agentic AI internally. So they aren't just selling AI, they're using it to build their own company.
How so?
Voyager is utilizing autonomous AI agents to dramatically reduce their own engineering design cycle times, optimize their manufacturing processes, and ultimately accelerate the go-to-market timelines for all these defense hardware systems.
The innovation strategy is just so aggressive. But it's not just happening in silicon and software. They're also innovating on ecosystems and physical real estate down here on Earth. The filings detail the creation of something called VISTA, the Voyager Institute for Space, Technology, and Advancement.
VISTA is a fascinating strategic maneuver by management. It is essentially the first of its kind U.S. science park dedicated entirely to in-space research and manufacturing.
And it's physically anchored on the campus of The Ohio State University, right?
Yes. The stated objective is to unite legacy aerospace primes, fast-moving space startups, academic research institutions, and government agencies into a single, collaborative, heavily funded ecosystem.
And they are taking this model global, too. The reports note a recent memorandum of understanding with Yonsei University in Seoul, South Korea, which is an elite global research institution.
Right. They are actively pulling South Korean biomedical and engineering talent directly into the VISTA ecosystem.
But why go through the trouble of building a university research park when you are trying to build space stations and missiles? It seems like a distraction.
Because VISTA is the commercial engine for Starlab.
Oh, I see.
Through VISTA, Voyager is actively cultivating the research programs and the tenant relationships that will ultimately occupy the space station in 2030. They are using the university ecosystem to prove the market demand and secure the funding pathways right now.
So it's a real estate play. Starlab is the multi-billion-dollar skyscraper they are building in low Earth orbit. And Vista is the leasing office down on Earth.
That is a perfect analogy.
And according to the 10K, the leasing office is doing incredible numbers. Vista has already pre-booked 130% of Starlab's commercial research capacity.
That metric is astounding to me. 3 years before the Starlab module is even scheduled to be loaded onto a Starship, they have successfully pre-leased every available cubic foot of research space and then some.
It thoroughly validates NASA's vision of a commercial space economy. The demand for microgravity research, whether it is pharmaceutical companies looking to crystallize proteins in zero-G or material scientists trying to manufacture flawless fiber optics, it far outstrips the volume of space currently available.
It does.
But paper demand and memorandums of understanding are cheap. Pre-leasing the skyscraper only matters if you can actually pour the concrete and build the tower. The aerospace industry is littered with startups that had beautiful slide decks and massive pre-orders, but failed to deliver a single piece of viable hardware.
That is the risk.
Does Voyager actually have physical, tangible infrastructure operating right now, or is this all just speculative?
No, they possess unmatched operational credibility in the sector. They aren't just a paper company. They own highly strategic, sovereign space real estate right now.
For example,
Consider the Bishop Airlock. Voyager owns and operates the Bishop Airlock, which holds the unique distinction of being the first and only permanent, privately owned commercial module currently attached to the International Space Station.
okay, but how does owning a door on the space station generate revenue?
It acts as the primary toll booth for the commercial deployment of payloads. If the European Space Agency, NASA, or a private commercial client needs to move sensitive equipment, scientific experiments, or deploy small satellites from the pressurized interior of the ISS out into the vacuum of space, they have to pay Voyager to use the Bishop Airlock.
So they are actively managing human-rated space hardware on a daily basis. They're already doing it.
Yes. They have executed over 1,400 customer space missions. They have facilitated the deployment of over 350 satellites. They are currently the largest commercial user of the ISS in the world. When CEO Dylan Taylor sits down with NASA leadership and claims Voyager can successfully build and manage the Starlab transition, he isn't speaking theoretically. The company has deep, daily operational heritage in the most unforgiving environment known to engineering.
Okay, so that covers the orbital real estate. But what about the ground infrastructure? Because if they have to execute on this $275 million backlog and build all these solid rocket motors for the Golden Dome, where are they actually bending the metal?
They are executing a massive industrial expansion right now in Colorado. Voyager just recently broke ground on the Voyager American Defense Complex located in Pueblo.
Pueblo, Colorado.
Yes, and this isn't a small testing lab. This is a 150,000 square foot advanced manufacturing facility. It is dedicated entirely to the high volume production of solid rocket motors, energetics, and the propulsion systems required for the Golden Dome interceptors.
150,000 square foot facility just for propulsion and explosives. That's massive.
And that is just one site. They also recently announced a massive expansion of their Denver metro facility, quadrupling its production capacity from 8,000 square feet to 40,000 square feet.
Quadrupling it.
Yes. And this specific expansion is tailored to churn out high volumes of their electric satellite propulsion modules to meet the demands of the commercial satellite constellations.
Okay, but quadrupling your manufacturing capacity in a single year is a blistering, almost dangerous pace for an aerospace company. Why are they rushing to pour so much concrete so fast?
Because it is a direct response to a massive systemic vulnerability in the geopolitical landscape.
Supply chain issue.
Right. The Department of Defense has publicly recognized that the U.S. and allied defense supply chain is dangerously brittle. Decades of consolidation have left the supply of critical munitions, specifically solid rocket motors and the underlying energetics, in the hands of a very small number of legacy primes.
Who move slowly and struggle to surge production when there's a crisis.
Exactly. The Pentagon is urgently trying to rebuild and diversify the domestic defense industrial base. They desperately need secure, redundant, American-based manufacturing lines that can produce these components at scale. So Voyager is aggressively pouring concrete in Colorado to physically cement itself as a critical node in that rebuilt supply chain.
Okay, so we have painted an incredibly bullish picture here. We've got record backlogs, a 1.3 book-to-bill ratio, orbital AI supercomputers, 130% pre-booked capacity on a future space station, and massive new manufacturing facilities springing up in Colorado to meet historical defense demand.
It looks great on paper.
The story sounds almost too perfect. And as an analyst, when the narrative is this clean, alarms start going off. It is time to look at the bear case. Let's address Wall Street's skepticism, because peering into the actual income statement, there is a massive red flag.
Yeah.
The space burn.
Yes. For all the impressive top-line momentum and forward-looking pipeline metrics, Voyager reported a severe adjusted EBITDA loss of negative $33.3 million for the first quarter of 2026.
Losing $33 million in a single quarter for a company of this size is a staggering cash burn. Where is all that capital bleeding out?
Well, the vast majority of this space burn is directly tied to the Starlab program. We discussed earlier that Starlab requires immense capital upfront for design, engineering, and the heavy innovation spend we detailed.
Right.
While they have successfully de-risked some of the manufacturing by partnering with Airbus and MDA, Voyager is still shouldering immense development costs to push the design toward the final launch configuration.
But didn't they receive a massive grant from the government to help build this? I recall reading about a $217 million award in the sources.
Yes, they were awarded a $217.5 million Space Act agreement from NASA specifically to fund the initial design phases of Starlab.
So they have plenty of cash.
Well, the Q110Q filing contains a sobering detail. As of March 31st, 2026, Voyager only has $10.3 million of eligible proceeds remaining to be drawn from that specific grant. They have chewed through nearly the entire initial funding tranche.
Wait, if the station cost $3 billion to launch, and they only have $10 million left in the NASA grant, where is the rest of the money coming from? This seems like an existential cliff.
It is the single largest binary risk hanging over the equity right now. Voyager's near-term future is heavily tethered to the upcoming NASA commercial LEO destinations, or CLD Phase II contract.
Phase II, okay.
NASA is expected to issue the request for proposals shortly, and they will likely down-select to just 2 winning commercial space station designs by late summer 2026.
So it's basically a winner-take-all scenario for the next round of government funding.
Precisely. If Voyager Starlab is selected for Phase II, they unlock the next massive tranche of federal capital, validating the project and ensuring its path to the 2029 launch.
But if they lose?
If they lose the Phase II bid, or if the broader U.S. space policy undergoes an unpredictable shift that cuts commercial funding, Voyager faces a catastrophic capital gap.
What happens if they lose? How do they keep the lights on for Starlab?
They would be forced to turn to the private capital markets under immense duress. They would likely have to issue highly dilutive equity, punishing their current shareholders, or take on incredibly expensive high-yield debt to keep the Starlab JV alive. The financial gravity of that scenario is exactly what keeps skeptical analysts on the sidelines.
Okay, that is a massive risk on the commercial space side. But let's look at the defense side, the segment that is actually generating revenue today. I was digging into the specifics of the new contracts, and I noticed the new Raytheon SM-3 pre-production award is structured as a firm fixed-price contract.
Ah, yes, firm fixed price.
Now, as a taxpayer, I love hearing the words fixed price. But as an investor looking at a company trying to scale up brand new manufacturing facilities, isn't a fixed-price contract a potential death trap?
You have zeroed in on the exact operational friction point that absolutely terrifies defense sector analysts. The mechanics of a firm fixed-price contract are exactly as the name implies. The price is locked in on day one.
No wiggle room.
None. Voyager agrees to design, manufacture, and deliver the specified hardware, in this case, complex propulsion systems, for a set amount of money, regardless of how much it actually costs them to build it.
So if Voyager signs the contract today, but next year the global cost of titanium doubles, or the specialized chemicals for the solid rocket motors become incredibly scarce and expensive, Voyager just has to eat that loss.
100%. They absorb all the inflation risk and all the supply chain volatility.
Wow.
Furthermore, they're absorbing the sheer execution risk of bringing a massive 150,000 square foot facility online. If they miscalculate the labor costs required to run the Pueblo plant, or if their scrap rates on the assembly line are higher than anticipated during the initial scale-up phase, the margin compression is brutal.
They could theoretically end up paying out of their own pocket for the privilege of building missiles for the government if the costs spiral out of control.
It happens frequently in the defense sector, and Voyager explicitly acknowledges in their SEC risk factors that they have experienced losses on fixed-price contracts in the past. When you combine the unavoidable friction of scaling up net new hardware production lines with the completely inflexible nature of fixed-price agreements, the path to maintaining profitability is incredibly narrow and unforgiving.
And reading further into the risk factors, there is a massive concentration risk, too. Over 83.5% of their total funded backlog is tied directly or indirectly to the United States government.
It is the ultimate double-edged sword of the defense industry. The U.S. government is the most reliable payer in the world with the deepest pockets. But if the macroeconomic environment shifts, if Congress fails to pass a budget and the DoD gets sequestered, or if geopolitical priorities simply change overnight, Voyager's massive revenue pipeline could evaporate.
Vanish.
Furthermore, federal acquisition regulations grant the government the unilateral right to terminate these contracts for convenience at any time.
Wait, they can just cancel the $78 million Lockheed order on a whim, and Voyager has little to no recourse.
They can recover costs incurred up to the date of cancellation, but the anticipated future profits vanish instantly. The concentration risk means Voyager is inextricably linked to the whims of the federal budget cycle.
So we have to synthesize all of this.
Yeah.
We're weighing historically massive catalysts, the $25 billion Golden Dome and the $3 billion Starlab monopoly, against severe execution friction, fixed-price margin compression, and a $33 million quarterly burn rate. What is the ultimate strategic outlook for Voyager?
Well, the analysts like the team at Citi have rated the stock a buy with a $36 price target. Wedbush is even more aggressive with an outperform rating and a $46 price target. They clearly believe the upside justifies the burn.
Does the next Lockheed thesis hold water, in your opinion?
The institutional analysts really view 2026 as the ultimate crucible. The thesis hinges entirely on Voyager's ability to successfully navigate the dual horizon transition. In the new term, can they execute on that massive 67% back half revenue weighting? Can they transition from being a boutique designer of space prototypes into a high-rate industrialized hardware producer without letting fixed-price contracts destroy their margins?
Because if they can survive the manufacturing scale-up in Pueblo and Denver and actually deliver the Golden Dome interceptor hardware profitably, what does the financial profile look like?
It unlocks a remarkably rare and durable financial model. The defense hardware segment generates robust, high-margin, predictable cash flows, and those cash flows essentially act as a financial bridge.
A bridge over the Starlab capital gap.
Exactly. The core question is whether the profits from selling throttleable rocket motors and star trackers to the Pentagon can successfully subsidize the immense capital requirements of building the commercial space station until that 2029 launch window, preventing catastrophic shareholder dilution.
Because if they can successfully cross that bridge, the math on the other side of 2029 is hard to comprehend.
The long-term projections for the Starlab ecosystem in the 2030s estimate up to $4 billion in annual revenue and $1.5 billion in annual free cash flow. If Voyager, as the controlling 62% partner, captures even a fraction of that monopolistic commercial space revenue, the current valuations and price targets will look like a rounding error.
It's staggering.
The brilliance of the dual horizon strategy is using the urgent geopolitical demand for defense propulsion today to quietly fund the infrastructure monopoly of tomorrow.
And that leads me to a final, somewhat provocative thought to leave you, the listener, with as you review these materials on your own. Let's assume Voyager executes perfectly. Let's say they survive the fixed-price contracts, they launch Starlab on Starship in 2029, and they establish a literal physical monopoly on commercial real estate and research in low Earth orbit.
A best-case scenario.
Right. And simultaneously, they cement themselves as the absolutely indispensable merchant supplier of propulsion and optical navigation for the entire United States missile defense shield. If they achieve that dual dominance, what happens to the legacy aerospace primes?
That is the big question.
Do massive entities like Lockheed Martin, Boeing, or Airbus eventually capitulate and just buy Voyager outright at a massive premium to capture that integrated value chain? Or does Voyager grow with such velocity and technological dominance that they eventually displace the legacy primes entirely, becoming the apex predator of the new aerospace hierarchy? The traditional blueprints for this industry are actively being rewritten. The landscape is shifting beneath our feet, risk defined, portfolio protected.